how much of your own is short-term one and how much of your own money is a long-term one, how much of others' money is a short-term one, how much of others' money is a long-term one. Then on the right-hand side, you will have assets, what you create out of money that you spend. Whatever things you create out of spending your mind are of two types again. One is a long-term one, the other one is a short-term one. The long-term one is called long-term assets and the short-term ones are called short-term assets. Now, the short-term assets are the ones that can be converted into cash very quickly, where the long-term ones take a long period of time to get converted into cash, and they do it in piecemeal unless you decide to sell off the whole of the long-term assets as one block. This is the first recap. The other recap is the valuations. Valuations, in short, anything on earth, anything that is with you is valuable. It has value provided it has a use. It should be of highest and best use that you can make of a particular item or particular thing. It could be your brain, it could be your intellectual property, or it could be anything in front of you that should have utility, and there should be demand and supply for it. The supplier could be you in terms of intellectual property, but there should be demand for the same in the market. And the third thing is everything should be legally transferable. Unless the good is legally transferable, it doesn't get value. It doesn't get much value. It may command a black value or unaccounted value, but certainly that is not what we discuss. So value is attached to anything and everything on earth. Today, we move on to what we call as business strategies. Business strategies are fundamental to any business that you start, and these are very basic and fundamental business strategies that we can adopt. Afterwards, we go back again to valuation and how we look at values through a cash flow projection that we are going to do live on this lecture. Now, let me take you to the presentation. I'm going full screen. I think the full screen is visible now.
Yes, sir. Yes, sir.
Is visible. So we go one by one and to understand what the business environment is. Now, when people talk as ecosystem, I always look at it as economic system. Ecosystem may be applicable for an environment in which you are working, but in terms of financial management, we look at the economic system within which we are working. So there are three aspects to it. One is an investment in long-term assets and money deployed in working capital or operating that investment. And then we look at how where we stand after investing, working on that investment, and then finally where we stand. That's balance sheet analysis. That's where we come to. Yesterday we did little bit of balance sheet analysis. Today we'll look at how balance sheet analysis and what it means for us. A balance sheet analysis, in short, is what I explained to you in summary recap in the morning. But let's go one by one how the business strategies are developing themselves into an economic system. Okay. Now, when you say you want to create an enterprise or operate an enterprise, it has to have a commercial intent. There has to be a marketing intent. Unless you market it, there is no point in thinking of any business. So, one of the primary driving factors will be commercial intent of your project. Now, I have noticed many enterprises in my life. One such was a coconut oil making unit. This particular enterprise started off with an investment of 50 lakhs. And even after 6 months, I found that he was not utilizing the capacity uh, which he had established, not even 10% of it. So I was wondering, and I asked him what is the reason why he is not using even 10% of the capacity. The reason he told me was he was not able to find a market for his product, or the prices that he was trying to produce was not being viably, it was not finding a good price in the market. Now, when you produce a 10% of a capacity, and then you are expecting the prices to be low, I mean, cost to be low, cost of production to be low, that itself is wrong. And then the market is already having a price levels. So you need to adjust your costs to the commercial levels. So that's where the unit was going wrong. So commercial intent needs to be from the beginning. You need to understand what the markets are, what level the markets are operating, and then you need to look at what will be your cost of production in case you have to enter a market. So we'll discuss in detail each of these items in subsequent slides. So then comes the technical capacity. So you need to know what is the technical capacity or technical part of the entire investment that you are making, whether you are capable of handling the technical part of the business, either as an owner or as an employee. So technical capacity, we'll be discussing each of these slides subsequently. So technical capacity is very crucial in a business. Imagine now commercial intent and technical capacity, we will now enter the battlefield. The battlefield is financial objectives or financial viability. So the financial viability is like a battlefield. That's where you try to manage both commercial intent and technical capacity in achieving financial objectives of making profit. So only motto in any business enterprise is making profit. No philanthropy, only profit. No NGO mindset, only profit. So this is what we look at in terms of any enterprise that you want to create. Then there should always be exit plans. In the beginning itself, you should know where you are going to exit, whether you are being forced to exit or exit with profit, exit without incurring loss. Now, many people keep asking me, when I'm starting the business, where is the need to plan an exit plan? Now, there is a beautiful example for this. Now, you remember Mahabharata, we have the story of Abhimanyu entering Chakravyuha. He was taught about entering Chakravyuha when he was in mother's womb. He knew everything perfectly, but he was not taught exit plan. So finally, what happened? Business is like Chakravyuha. It is an absolute Chakravyuha where there are enemies, there are friends, there is everyone, but they are all gunning for your failure. Most of the times, very few people aid your success, but many people gun for your failure. So you need to know the exit plan right from beginning, plan for it, but in stages. So we'll discuss this in detail over the next few slides. All these things, if you remember, always remember, financial management is the battlefield where we need to move your chess pawns perfectly well in order to be successful. So the chess pawns are like, you should know how to move knight, you should know how to move rookie, you should know how to move the king and how to move the queen and protect your entire business. So there will be no chance of checkmate from any small competitor or any small new entrant or any other factor. But remember, in chessboard, even a small knight can challenge you and checkmate you. So one small downside will destroy your business. So be careful. Financial management is fundamental to all other aspects that you are seeing on the screen. So financial management and exit plan, we will look at these items in detail over the next few slides. Commercial intent is you should know the market size. Many a times people ask me, how do you decide the market size? Now, let me give a recent example. One guy was trying to produce a antiseptic using silk cocoons or silk embryo, silk cocoons. He was using waste silk to produce a kind of antibiotic chemical. Now, the moment he started off talking to me about world market. He said, in the world, this diabetic patient size is so big that this has a wonderful market. But the market size that he is trying to look at is hardly 1 or 2 crores or 3 crores or even 5 crores. He is satisfied. Why should I talk about world market size? I need to look at what is the market size available to me near me. One of the basic principles of any market is, do you have a domestic market? I'm sorry, I'm coming back to the. I'll go back. Uh, One of the basic things that Robobank in its report says is that if the domestic market is strong, you can explore international market or export market. If the domestic market is not strong, you cannot export it freely or easily. There is always a bottleneck. So he gives an example of Netherlands. In Netherlands, you may be aware that Netherlands, Amsterdam is like mother of all agricultural auction centers, especially the flowers. From all over the world, flowers drop into Amsterdam, and then it gets distributed again to entire parts of the universe and parts of the world. Imagine there is a center to which a flower comes from every part of the world and then gets distributed across the different parts of the world. Now, the demand for flower in Netherlands itself is sufficient. The country is sufficiently producing flowers that can be catered to domestic market. But what they realize is the domestic market is so strong that they try to buy cheaper flowers for the domestic market, and the domestic products which they produce, they try to export at better prices. Now, this is the mechanism which RoboBank realizes and comes back to us and tells us, first you explore domestic market and then see what is the size of the domestic market that you can cater, and then think of external market or export market. Anyone having any questions at this stage?
सर उसको बोलता रहिए ठीक है शरद को जल्दी
First, no
एडमिट
one.
कर जल्दी जल्दी
Yeah,
Everyone is.
I have one
जैसे
Hello.
question,
रिक्वेस्ट
sir.
आता
I have a
रहेगा
question.
लोगों का
Yeah, yeah. Please go
कैसे
ahead.
एडमिट कर अभी तक तो 45 लोग गए
Actually, you just said for starting a business you need a market size, and for that you need to explore first the domestic market, right?
Yes.
And
To
what if
begin with,
if
to begin
what
with,
if somebody is competent enough, some organization is competent enough directly to support the uh, outside market in terms of export?
when you say they are competent, there is no, the question does not arise for an explanation. But the general rule is there a domestic market? The domestic market for your product, if it is strong, you can always export. You can always export. Remember that you can always export provided domestic market is strong, is the principle of marketing. It is not a rule that you have to follow this rule only, but the principle says is, if for an agriculture commodity or an agriculture product, domestic market is strong, you can always export it without much difficulty.
Okay.
The reason is, in case the external market drops, you are able to sell it in the domestic market.
Right, you are right. Thank you, sir.
The underlying concept is that.
Sir,
Yeah, please go ahead.
yeah, sir, my name is Raji. I'm from a startup company called NaaViC, which is into for farm automation devices, okay, semiconductor devices. So we are very early stage, and we have still not very strong in the domestic market also. But still we have got a few order from other countries. So that means we have to stop it there, right? No need to
No,
work ahead. I
no,
just
no.
took the export.
No,
Okay.
it is not like that. It is not like that. You are not. See, what I told is a basic rule or basic principle. The principle that you adopt is if the domestic market is strong, the exports can be done comfortably or easily. Because in case the export orders stop, you can market it in the domestic market comfortably, right?
Yeah.
Now,
Yeah.
let's take the
Yes.
example of COVID situation when most of the export consignments were held up. Suppose there
Correct.
was a strong domestic market, these export consignments could have been sold in order to release cash or generate cash for yourself within a given period of time. This is not
Okay.
a this is only an underlying principle. This is underlying principle after studies all over the world. Okay, the underlying
Okay.
principle is if the domestic market is strong enough, your export can be easier or comfortable. Else, what happens is if the domestic export order is cancelled, where will you sell the product?
Yeah, this is what happened. The order came and it is stopped when the corona this problem started.
Yeah,
They kept it on hold. They don't want it now. Okay.
yes.
Yeah. Thank you, sir.
Now, what
Thank
happens?
you.
You are stuck with the inventory. You are stuck with the inventory, and you cannot convert it into cash in the required time. So that's where
Yeah.
your liquidity gets stuck. Therefore, one of the underlying principles of export is or export market is domestic market should be strong. So whenever you go back to um, 1 minute, let me go back to the slide. The slide is visible.
Yes.
Yeah, slide is visible. Now, one of the things is first, whenever you look at commercial intent, you look at the domestic market first and then the export market. So let us first talk of our own city, whether there is a market. Next, our own taluk, whether there is a market. Then our district, whether there is a market. Then our state, there is a market, and then it goes on to the country, and then neighboring country, and then
Hi, good
countries
morning.
beyond. This is like something like you flower out
Very good.
slowly,
Okay.
and then keep on exploring
Sorry,
the market
no.
all over the world till
ಇಲ್ಲಿ
you are
ಯೂಟ್ಯೂಬ್ ಲೈವ್
100%
ಹೋಗ್ತಾ
sure
ಇದೆ.
that you have a domestic market or easy conversion market. Easy conversion
ಏನಂತ ಇಲ್ಲ
market
ಅಲ್ಲಿ
means your
ನೆಕ್ಸ್ಟ್ ಫ್ಲೋ ಇರುತ್ತಲ್ಲ
inventory
ನಾನು
could get
ಅನ್ಕೊಂತೀನಿ
sold
ಅದಕ್ಕೆ ಇಲ್ಲಿ
easily in a domestic market so that you are not stuck with inventory or cash
ಸಿಸ್ಟಮ್ ಅಲ್ಲ
getting revolved.
ಸಿಸ್ಟಮ್ ಅದೇ
So
ಆಗ್ತಂತ
this is
ಸಿಗಲ್ಲ
one of the basic principles. There are exceptions. There are 100%. There are exceptions. There are exceptions to this rule,
ಆರಾಮಿಲ್ಲ
but this is the
ನೀವು
underlying principle. So whenever you look out for commercial intent
ಜಾಯ್ನ್
order
ಆಗಿದೆಯಾ
intake,
ಜಾಯ್ನ್ ಆಗಿಲ್ಲ
you look for the domestic market, the
ಏನು ಜಾಯ್ನ್
market
ಆಗಿಲ್ಲ
size in the domestic market. Then we go for who are our consumers. We call it as consumer analysis. Who are our consumers? Whether that consumer size is an expanding one or a limited one or a contracting one. We try to look at it.
ತಿಂಡಿ
Now,
ಆಯ್ತಾ
let us try to look at the telecommunication market, which people thought that before geo entry and after geo's entry, you look at the market size of telecom industry, you find that the market has expanded, but the earlier players have lagged behind. The market has certainly expanded. Then what made the market to expand? So there was a strategy on the part of Geo to expand the market in terms of attracting more customers with lucrative offers or reducing the cost of communication. They reduced the cost of communication, therefore they made it affordable. Now come back to other players. They want to be premium players, therefore they have kept themselves in a very smaller portion of the entire market size. That market share is comparatively lower than that of the Geo. So market size is about consumers, understanding the consumers, and then whether it's an expanding consumer size or a contracting consumer size, or what is the nature of consumer. Is a repetitive customer or a loyal customer, or every time the, the product stops at him and then you go in search of a new consumer, or what we call as whether your product is frequently replaced at your consumers end. So if it is frequently replaced at consumers end, then you have a loyal customer base that you are creating. And then also comes in deciding the consumers, the season, especially in agricultural products, you have seasonality. Now, how do you manage the inventory to meet the demand throughout the year? So these are the discussions you may have to make. Once again, I would love to go back to the previous slide and show you that whenever you want to write a report, your report should have all these four headings. Whenever you want to write a report on your project, the report should necessarily contain these four aspects. Exit plan is also called as succession planning. Exit plan is also called as succession planning. How do you want to keep your business in succession, that it continues to be in the business, or who is going to take over, or who is going to run it for a longer period of time. So succession plan is also called exit plan. So you remember always whenever you want to write a world report or a project report, these four items are necessary to be addressed in a paragraph before you submit it to any financing agency. So you can write 100 and odd things, but if these four aspects are presented very well in a stronger way, that means your project report is really conclusive and attractive. Now, I have seen many project reports where people start with technicality of the whole applicant. When I saw one in one rose garden project report, one guy writing about botany of entire rose crop. There is no need for that. We don't require the botany part of rose garden in a project report. What we require is techno-economic capacity of the rose plant. Techno-economic capacity is something like the rose plant behaves well in a plant population of so many. These are the varieties, and each variety has different yielding pattern, and this is the field requirement. This is the feeding requirement. So we talk more of techno-economic parameters and the technical capacity. And then when it comes to financial objectives, we talk about investment. So whenever you write a report, please bear in mind you have to write necessarily about these four aspects in your this thing. So we come back to commercial intent. We have seen the market size. We talked about market size in terms of domestic market, local market.
Sir, I have
The,
one question. Can I?
yeah, please go ahead.
Sir, I wanted to start the farmer production company
Yeah,
in my village
yeah,
where there is a lot of resources available. That means raw materials are available.
okay,
The banana, coconut, and all.
yeah,
But that is a remote village.
yeah,
From there, the market size is very limited.
yeah.
So whether I can start that the farmer production company in that wherever the raw material available, or I can look into that the nearby city.
Now, look, there is that's a wonderful concept, the farmer producer organization. Unfortunately, it has been largely misunderstood or largely being put in a different meaning. Um, See, generally all over India, one of the things you should remember is the per capita income of farming activity. Farming activity includes everything: dairy, poultry, agriculture, horticulture, everything. Is around 25,000 rupees per person per annum in all rural areas on an average. Okay, don't come back to me and say that this is higher in the village. On an average, throughout the country, so on an average, it's only 75,000. That means the farmer's family has a maximum revenue, or what we call as gross income, of 1.25 lakhs if there are 5 persons in family. Now, when you come to the urban area or non-agriculture area, the per capita income jumps up to, per family income jumps almost like 8 times or 10 times. So it is around 12.5 lakh rupees. Now, when you want to do a farmers producer organization of as a concept, you need to see how you need to double that per capita income. So in order to improve the double to the next level, what is required is the farmer producer organization should enter non-agricultural activities, non-agricultural service provider, not necessarily trying to get more value for agricultural products. That is one part. What you are thinking is one of the parts. But if you want to increase the farmer's income, it needs to be from the non-agriculture side, or what we call as services sector. So unless the FPOs enter services sector, you will not be able to gain this level of income that you are desiring for the farmers producer organization. Let me give one or two examples. One example is there is a farmer producer organization called Goa Bagayatudar Sangh Niyamit. That's a cooperative. This was established in 1962. Today, their turnover is around 300 to 400 crores. It is a farmer producer organization, nothing else. But they are not marketing only farmers' products or raw material, which you are talking. In fact, they are not raw material, they are actually final products at farmers' end. Okay, final products at farmers' end. Now, they are not marketing much of these farmer producers or farmer products. They have entered retail marketing chain for all consumer goods and all day-to-day use goods, what we call as FMCG items. And you should see that's a beautiful chain operated by farmers. They have entered non-agriculture sector to improve their income. So they are having a turnover of 300 crores. This is called Goa Bagai Darshan. In case you are interested, just visit them and talk to them as a FPO promoter. It's worth doing it, and take farmers also to show them how it is operated. The second one is the most wonderful one. This is again started somewhere in 1947. Imagine 1947, a farmers producer organization in the form of a society. It is called Kolhapur, Kolhapur Shetkari Sangh. It's called Shetkari Sangh in Kolhapur. They have petrol pump outlets more than 6 or 7. Their turnover is 150 crores. Their business started with marketing only jaggery from farmers. They used to buy jaggery from farmers and market it. Today, they have petrol pumps that market almost everything they want. And imagine, as an FPO, they are getting into non-agricultural activity and getting more turnover for the farmers. You need to look at these aspects rather than focusing or finding out a market for yourself in terms of what farmer is producing. The maximum value addition that you can make for farmer producing farmer products is at village level or FPO level is hardly 10 or 15%, maximum 20%. So, my dear friends, you should remember that whenever you talk of FPO, it's a different domain, but the domain should understand that the maximum income or maximum uh, profits that can be passed on to farmers can be done mainly from non-agricultural activities rather than focusing on agriculture-based activity. Trust I have answered your question. I need to move on.
Sir, only that two company names. Can you do it in that chart column?
1 minute. Okay, 1 minute. So you're convinced at least?
Yes, sir. I'm very impressed because now I'm working in private company, but my destination is that farmer production organization where we can do that value added products, because there is a huge amount of source raw material is wasting. So I am planning to what is that to include around 500 farmers to make that farmer production companies, and will get government subsidies also, will go
Okay, I
into
think
that.
we should stop. We'll proceed further.
Yes, sir.
I'm sorry, I have to proceed further because time is limited and we have a lot to cover.
Yeah, that company name is entered, sir.
I have already sent you.
Okay, sir. Okay, thank you.
So commercial intent and this one when it comes, we have decided, we have talked enough about the consumer, what kind of consumer you are targeting, what kind of market is that, whether an expanding one or a contracting one or a stagnant one. And then cycle of market demand, especially in agricultural product, there's normally uh, seasonal, so you have a lot of problems with it. So you need to devise a mechanism of continuous supply and continuous demand. Then comes the recession cycle. Believe me, friends, if you study about 100 years history, the recession has occurred only between 8th and 10th year of every decade. So every decade you have a serious issue with recession between 8th year and 10th year of that decade. Now, if you look at it, 1948 we had recession, 1958 we had recession, 68 we had recession, 78 we had recession, 88 we had recession when we pledged gold with UK banks. Then 98 everybody knows there was a Korean recession. Then 2008 we had US recession. In 2018-19 we are already having recession. So recession is a factor that comes between 8th and 10th year of every decade. So you need to prepare yourself for that in much earlier than somewhere around 15, 16 itself you should plan to attack the recession cycle that happens uh, during the 8th and 10th year. By history, this may not happen for your product, but you should be cautious about it. Then comes the factor called competitors. So there are competitors to you in many ways. Talking about competitors, I had an example. One guy started on producing a metal powder. Okay, he was number only second unit in the country. It is the only second unit for producing metal powders. The first unit was in Pune and it had 90 to 100 crores turnover. Now the second guy's capacities or the market size that we had planned was only 10 or 12 crores. But he was killed by that 90 crore competitor, 90 crore turnover competitor, sheerly by cutting down the prices. So surely the 90 crore turnover guy cut down the prices of the product to such a level that it became impossible for the new guy to enter the market. So you need to devise methodology to meet such competitors. Yeah, sorry, any questions? Okay. Now, that is the kind of competitor. Of course, there was errors on the part of this new unit that we can discuss when we have time or in advanced course. Now, existing marketing system also, whether it's a distributor, dealership marketing, or e-platform marketing, or direct marketing by you in the market, because you have time and you have money, you have known customers, so you can talk to them directly and sell your products. Then innovative supply chain. Can you think of an innovative way in which you manage the supply of your raw material at a cheaper cost or supply your own product at low cost to your customer? So can you think of an infrastructure that is required? We had this issue when we had rose projects coming up all over the country in 1992. There was no cold chain infrastructure, but everybody wanted to export out of cold chain. So the whole thing collapse. So you need to be very clear about what kind of supply chain you are targeting for raw material as well as for supply of your own product. Then success and failures of new units or similar units or any units around you is very crucial to learn from them, whether why they are failing, how they are failing, what happens to such units upon failing. Now, what could have been corrected in such unit needs to be understood in a domestic environment within your location or within your state or within your district or within the entire country, why such units have failed or succeeded. These factors will also help you to understand the market and how the market has responded. Now we go to the technical capacity side. So technical capacity is one thing that you need to understand very carefully. Now, for this, I will take you to another slide for a minute. I'll take you to the slide subsequently after I complete this. You need to define the capacity in terms of technology that is available to you and technically how many units you can produce in a day. Technically, that means entire assembly line, how many units you can produce in a day. That is perfectly fine and working. So testing should be over and everything should be completed when the product is leaving the factory. So you should define how many I can produce technically correct and marketable product. So you have to define the capacity and in terms of technology available with you as well as technical personnel available with you and the machinery that you have established in terms of production. We also need to know the life and expiry time and technology obliteration of these products in terms of technology. There are many units, they startups, especially they start up with a product, but by the time they bring out the final product, there are competition or the life has expired or the technology has obliterated. Uh, Recently, I remember one such case where technology failed. Yeah. See, one guy was one startup company started with an app for farmers, which gave them technical consultancy on crops. Okay, but he never realized that that particular app can be repeated or copied or can be improved upon and brought
Hello,
into the
sir.
market. So he was very happy about the product and the product started moving
Uh,
very fast.
yes, madam.
First and second year of operation was very good.
Yeah, yeah.
Third year it started dropping because there was a better technology, better consulting available over the app, and therefore the life of what app he had created, it had lost its life, or it became technically obliterated, or it was not being accepted in the market anymore.
Nivedi, I don't
Fortunately, this
know
guy
because
did
I'm
not
just a
find
scientist. You have to
succession
talk
for
to
his
maybe
product,
complaint authority,
or he should
director.
have iterated his product for the subsequent requirement of the farmers. That he has
Director,
not
director
done.
number you have
He
to call
was
because I'm
so
just
these were
a
some of the
scientist. That's it. They
instances
are
of
the people who
one
take care of
instance
that.
of
Hmm.
expiry of the product or technology. So
That is very well right.
technology has a life.
Yeah.
Remember, every
The number
technology
is in
has
the
a
web,
life.
I think. Website
It
it is there. Hmm?
it loses its
Yeah,
importance
yeah,
after
yeah.
that period of time,
Okay.
until and unless it is improved upon or it is changed upon.
So,
Now, the simplest example is the cell phone. Now, the cell phone is, if you look at Nokia of 2003, 2004, and Nokia of today, what kind of technological transformation has taken place, and why OnePlus 7T is bringing an update or update into its software or update in terms of hardware. Why is it doing is because they want to remain in the market by giving you a little bit more for extra money. So because they also feel that technology may I mean, it may lose its life. For example, before 70, the screen had hardly 50 or 60 gigahertz of response. Today it has 90 gigahertz of response. And come OnePlus 80, it has 120 gigahertz of response time. So you need to see that people change their product or keep on updating their product in terms of in order to meet the life or extend the life. We'll see some of the graphs which will show you why and how the life of a product or life of a business is determined and how they behave. So infrastructure requirements, the technical capacity also means technical infrastructure. Now I have a project wherein I have to establish a 1 lakh liter milk processing unit. Now 1 lakh liter of milk should be processed every day. Now, what kind of infrastructure I require? I require minimum 5 acres of land, and then about 4,000 to 5,000 square meters of construction. Now, construction technical requirement is it should be of 18 feet high, temperature controlled, temperature management within the structure, and it cannot be of asbestos roof. I need to have it of RCC roof. Now, these kinds of technical infrastructure also needs to be looked into and explained in your report. Then of course one cannot be completely competent technically, therefore we hire human resources. So the human resources cost and human resources requirement needs to be properly understood and engaged. And then whether your technology is indigenous or imported, again this is very crucial. In 1992 when we started with polyhouse projects, the cost of polyhouses was something like 2 crore per hectare. Today it has been brought down to 30 to 35 lakhs per hectare. Now imagine imported technology in 1992 was around 2 crores. Today indigenous technology is at 30 to 35 lakhs per acre. If I'm not, yeah, it's around 35 lakhs per acre. So that's the level to which indigenous and imported technologies provide you cost management or cost efficiencies in terms of capital assets that you create in your unit. So the cost of imported technology, and then raw material availability. Just now, one of my friend was talking about raw material availability locally. So raw material availability locally is fine, but technically, whether the raw material that is available to you is suitable for your type of production. Now, for example, in Davangere, maize production is done in large quantities. Whether that maize is suitable for human consumption or is it suitable for poultry or animal feed consideration. Now, maize grown in Shimoga and southern part of Shimoga district, they come into the sweet corn type of varieties, and that is good for human consumption. Now, raw material availability needs to be looked into in the lens of technically being suitable, at the same time available in the nearby areas or distant areas. How do you check the quality of the raw material if it is coming from a distant area? Now, all these things need to be discussed when raw material availability. Any questions so far? Anybody? Any questions?
Yeah, there is one question from me, Raji, again from Nelback.
Yeah.
I have a question on such one point you said that about supply chain. We have to take care of the raw material and also the product what we are selling. Can you please throw a little bit more light on it? I did not understand it completely. What should I be careful
Okay. Now, what
about the
product
supply
you
chain
said
of
you are
my raw
handling
material?
semiconductors, no?
This is yeah, electronic product which is doing farming. We have the drip irrigation
Oh,
modeling. Yeah, this automation of the drip. That electronic device we are manufacturing.
Okay, now let's
So the
understand the
raw
parts of
material
the
will be,
business. Yeah, let me try to
yeah.
explain that point. Now, when you say semiconductors or any part that is being used in automation or semi-automation, is it you are assembling these products or you are purchasing?
So we are actually making by procuring
You are
only
manufacturing.
the components. Yeah, we are manufacturing it completely
You are
from here.
procuring what? Sorry, you come back. Your voice is
Bangalore.
breaking.
Completely, sorry, completely we are manufacturing in our office in Bangalore. Completely we have made small setup. Okay.
But where are you procuring the raw material from for manufacturing?
Raw material here we are taking it purchasing it from one company which is from Hyderabad. Raw material like electronic, like capacitors
Your
and small electronic
your voice is
components.
breaking.
We
Yes. Now what I understand is you are procuring certain components from Hyderabad or from different places. Now, when it comes to you from Hyderabad,
yeah, they might be bringing it from abroad. I don't know.
yes, yes. Now that is the
We are
thing.
not purchasing it from outside.
How do you ensure a quality supply and supply in time is what I was meaning. When you say supply chain of raw material, how quickly you are able to get it, how good quality that it is, and how how your supplier is rated, and what is the success rate you are feeling about that particular product, whether you can source it from a nearby guy who is supplying it to you at a cheaper rate. This is what is called innovative supply chain. And what is the alternate sources, and then how quickly you can rely on the nearby source or a distant source supplier. So supply chain is about how you ensure a quality supply of products to your factory, raw material to your factory. And then forward supply is how you have planned your inventory flow from your factory into the buyer or dealers end. Now, I'll give one example here. There is a unit near Bangalore which produces a herb called chives. Chives is nothing but a thin onion herb. Now, this herb needs to be produced, and for which the seeds come only from Hyderabad. And the seeds are procured from Hyderabad, and they try to produce the seedlings, and unfortunately this, the germination rate falls below 40%. He has to rely on international market to get the seeds. Now, this is what supply chain he needs to be relying upon or arrange it in order to meet the season. Now, the season starts in the month of June. He has to be ready with the seeds in the month of April. Now, when he gets the seeds in the month of April from Hyderabad side, and he realizes that the germination rate is poor, he decides to import it from France. Now, importing it from France means in the month of April, if he orders, he will get it only in the month of May or May end. Now, by the end of May, he conducts germination test for the imported material. He doesn't get it to the required level. Maybe it's at 70%. So what happens is his June planting is either getting delayed or it is getting uh, disturbed in terms of required plant population. It gets distorted. The production program goes for a toss. So now he need to plan this supply chain much in advance, and then store them wherever it is required, and ensure that he is protecting his working capital also. It's a complex issue, but one needs to keep an eye on it. Now, after he produces, he needs to supply that to Europe within 12 hours. So from Bangalore to Europe, the finished goods should reach within 12 hours under cold chain. Imagine how he should plan it. Now, the innovative plan is he processes everything by morning 4 o'clock to 6 o'clock time under a cold chain, sends it to domestic airlines domestic airport, international airport near Bangalore under cold chain, and he plans with the airlines that he gets the coldest part of a aircraft in order to store his product, and he sees that the product reaches Amsterdam by about midnight, 12 o'clock or 2 o'clock. Now, this is, he has to plan it, otherwise his entire goods will go for a loss. So that is what is called as, you have to plan your in supply chain in such a way, neither your raw material supply is disturbed nor your supply of finished product is disturbed. Okay,
Okay,
so
sir. Thank you so much.
I think I have answered your question. In case you have further
Yes, yes,
knowledge,
yes. Thank you.
yeah. Now we come to financial objectives, and we have discussed this yesterday. Profit motive. Without making profit, there cannot be a business. Otherwise, it is called charity. Whenever it's charity, it means you are begging with someone to give someone. So you beg with someone to provide money to someone else, to a beggar. So that is not correct. The profit motive is, everywhere you make money and then you just be with it and you make charity a part of your profit. So let me make it very clear. When you say you are in business, it's only money making, more money. So profit motive, if you don't have, don't call it a business and call it something else. Please don't call it a business. Now, not only profit motive is important, whatever assets you create, it should be of top quality. Whatever assets you create. Suppose, let's say you have created a factory out of your money and in terms of investment. The factory should be in such a way that people who come there should say, oh, assets are in very great condition. Even after 20 years, it should command a value. The depreciation should only be a book entry, but the asset should be in such a way that it carries value. Now, this value creation is a kind of an art. It's an art. What we call as appreciating assets and depreciating assets. How you build appreciating assets within your factory, or how you build depreciating assets within your factory. So this is an art. So objective is that you create assets which add value to it by on its own or by maintenance. Suppose I go to a factory which I want to buy and I see that the assets are very old, I may not give much value. Now, if you visit one of the tea factories in Assam or elsewhere, most of the assets are centuries old. Most of the factory machinery are centuries old, at least 1 century old, but they are only maintained to keep on working. But you cannot say they carry value, but they are there functioning like a dog. They just function. They don't do any other work. But if you go and say, I want to buy it, it may not carry much value. It will not carry value for its existence as an asset. It carries value only in terms of function. But what I am talking is, as an asset, it should be a value. Now, if you see many of the employees who are treated as assets rather than persons who come and work there. Sundar Pichai is an asset to Google. He is not a employee. He is not a guy who is a, so he's a guy who has been created as a value for the company. Same way you talk of Indra Nooyi, they are all assets with value that have been created over a period of time. So they are assets of the company, not just employees or guys who come in and just get out. That kind of people are not there. They create assets. Now, as an enterprise also, you create value. Now, let us take a simple example. Let us consider our families. Our families are an enterprise. Now, what do we work with our family? We try to create a value for our family. So, as an enterprise, we create a value. So, in this society, you want your family to be considered as good, well behaved, very well placed, and well doing, and respected, and all that. Now, your enterprise also should create a value in terms of being a good enterprise, a very well functioned and managed enterprise, having good assets within it, performing very well in terms of profit motive. Now, all these things are decided in a good balance sheet. So the good balance sheet, it tells you how much is your own money, how much is others' money, how much is short-term funds deployed, how much is long-term funds deployed, what is the liquidity, what is its sticky areas. Now, it is defined in the balance sheet as we discussed yesterday. Same way, it also shows how liquid are your assets, how quickly your assets can be sold, or how quickly it can be converted into cash. So value creation enterprise is a separate issue. Value creation assets is a separate issue. Profit motive is in terms of operations. And then all these things boil down to what is called as a good balance sheet. Now, when you talk about good balance sheet, there should be capital growth. That is, your own money should increase in the business rather than others' money increasing, or the borrowing should not increase. Your own money should increase. That is the motive of financial. That's the financial objective we should have. I'll give example. Uh, 1 minute. Let me. Unfortunately, I don't have the ready open this thing. I won't be able to share it with you. Probably in advanced this thing, I'll be able to share it with you. See, capital growth is nothing but when you make profit, profit gets added to your own money. In a balance sheet, that's how it operates. One side, you are operating to make profit. The moment you make profit, the profit is added to your own funds in the balance sheet. So as a result, the capital grows. Let us take, for example, startups. The startups have a fad that I want an investor. I want an investor who gives me money. Okay, invest money in the project. For what? Let's say for if I have a company, a startup, and I want about 15 crores, and one investor comes and says, okay, you have a very good startup. I'm willing to pay 15 crore or invest 15 crore, but after 3 years or 4 years, I want 4x to exit. He wants to exit after 4 years, and he wants 4 times the money he has invested. Now imagine it is others' money which is coming into my company. Now I have to slog in such a way that after 3 or 4 years, he takes away 60 crores from my business. And what about me? How much money I should have invested and how much it should have grown? Suppose I have invested about 1 crore, should it not grow to 4 crores? If that guy is taking 15 crores and taking away 60 crores, should I not have my capital growth? That is the question we have to answer in terms of capital growth. If you can give money in terms of interest and 3x or 4x return to somebody else, you should be able to get that particular growth for yourself also. That is what is called as capital growth. The moment capital growth is there, a good enterprise is built. And then one of the major objectives of all these things is you protect your credit rating in the market. Unfortunately, in today's world, whether you borrow or you don't borrow, there has to be a credit rating. In case you are staying in United States, credit rating is part of your social security. It's a part, it's inbuilt into your social security system. So credit rating is one thing you have to take care or address right from beginning in order to see that you have a capital growth, you have a profit growth, you have an asset growth, you as an enterprise are valued. So these are the major objectives of uh, financial side. So when you write a report, you need to write about these things. Any questions? Any questions?
Good morning, sir. I have one question. Subhashish from ICE.
Can you speak loudly? I'm not able to
Sir,
hear.
sir Subhashish Sahu from ICE Foundation, Odisha.
Yeah, go ahead, sir.
Sir, basically, sir, for a manufacturing unit,
Yeah.
value can be estimated from the assets from the land and building. But
No,
normally or
no.
from the transactions. But for a service enterprise, how we will evaluate?
See, any enterprise The value is arrived mainly from the profits you are making. You remember utility, supply and demand, and transferability. All these three characters are of that of a value. So when you want to create value, unless you show profits, you don't gain value. You may have assets. The asset value is different, but the value that you create for your enterprise is only in terms of your performance. Now, let's say as a service industry, you are performing with a turnover of, let's say, 10,000 crores, and your profits are only 1,000 crores or only 5,500 crores. Now, when you are having 10,000 crores, easily the value is determined as 20 crores, two times the sales value. Otherwise, if someone wants to be explicit by looking at the nature of your business, he will go with profit method of valuation. He will value your business at 6,000 crores. Now it depends on how much profit you are making or what size of the market you are capturing. Yesterday we had an example of geo platforms. Why geo platforms with a sales of only 20,000 crores is valued at 4 lakh crores? Because he has got a huge market size, and that market loyalty is very good. These are valued, and therefore, even if they have an additional service added to it, he will make profits of unimaginable magnitude. Therefore, he has been valued at around 4 lakh to 5 lakh crores. Now, again, availability of geo shares to you, it's not easily available, so people try to pay money for his share. Now, this is how a service sector is also valued. Any valuation comes either from sales or from profit. It's not from the point of view of assets that are left. When you look at value of assets, it is only when you want to close down your unit. When you want to close down your shop, the assets are valued at its book value or at market value, or who wants it, who doesn't want it. Is that clear, sir?
Yes, sir.
Sir,
Thank you.
please do not use the word transaction. Please use operation.
Okay.
Whenever you talk to somebody, always use the word operation. Don't use the word transaction. Transaction is
Okay.
always one transaction. Operation means for the whole unit. So we will become more professional in our approach to business. Right, sir? Now we come to any other
Right,
questions?
sir.
I trust I have no questions.
Sir, this is Tim again from Chennai.
Any other
Sir,
questions?
yeah, Timo here. Can you hear me?
Yeah.
Sir, yeah. For the business, we want to be profit oriented, but in agriculture, still we need to have a hope for the profit and all. But sometimes it depends on nature and all.
Yeah.
So it's a hypothetical question, but uh, we have to continue our business or production or efforts, even though we are incurring losses. Right?
Now, agriculture, this is a, I've spent almost 4 decades in this field, grassroots level. All that I can say is it's a business. Carry on. You have to be ready for volume, and you have to be ready for vagaries of the nature. And you are always limited by the number of, number of acres or your unit size. It's always limited, especially in India. The psychology of agriculture is small holding, small farmer, marginal farmer. That's where the whole thing is stuck, and that's where the units become unviable and unprofitable. They are not capable of sustaining the vagaries of the nature, and unless you are big and you are able to diversify and plan well in your business, controlling costs, and understanding the market, you will not be able to make profit. And also, let me tell you one thing: sheer agriculture will not help you. You also have to have non-agricultural activity attached to agricultural activities. Is that
Okay, sir.
clear?
Yeah. Yes, yes, I agree.
We can discuss this issue
We have
because
to
it's a
balance
very
both.
sensitive issue. But I am straightforward. I don't share about these things.
Okay.
I don't keep anything in my heart. I keep telling it. But we have a psychology of always telling farmer is poor, farmer is having problems, agriculture is a problematic thing, and still agriculture continues to be a prime business everywhere. You drive the uh, food industry and then you say that you are not profitable. I mean, there is something that is lacking. We need to correct. According to me, the correction is possible. You need to diversify at least a little bit in order to ensure that you are sustaining your farm sustains and you have become profitable overall. So we will see that in the next few slides where we take this one to the next this thing. Okay, we'll go to the next slide.
Just a second,
Yeah.
Satishan. I request all the participants to mute your mic. Actually, it's creating disturbance in the background, and we are streaming lively in YouTube, so please avoid that.
Okay. Now we go to the next one, exit plans. Why and when? See, exit plans are wonderful aspect of business. Um, we divide the entire business into phases. That's the initial phase when it is in a baby stage. Then the growth period when we call it as the primary school stage to college school stage. Then the prime stage when it is performing or after college or employment stage of a kid, of a children, of our children. Now, exit. Would you like to exit business because you are not profitable in the beginning itself, because your product design is faulty? You want to exit? That is possible. It is with minimal losses. Now, exit business when it is taking off, but unfortunately your finances or external factors are not permitting, or technology has failed. So you want to exit to limit your losses in future. So that's second level of exiting. Third level is you have launched the business, but the competitors are hammering you down, and you want to exit business. Okay, sell it off in order to reduce losses and tension. You can quit. Now, exiting business is a easy thing, easy decision, but how you manage the business is not just exiting the business. Exiting business is only a last option when you have to decide about bearing continuous losses. You need to decide on exiting business. So that's in fact the last option. Some cases, the exit plan includes partner exiting by paying more money to the one of the partners. He says, "Okay, I want to make money, so I will take my profits and the premium, and I want to quit. So you continue with your business," is what one partner tells the other partner. In case of startups and companies, we sell stakes or ownership of our company to others to the extent of 49% generally, in order to keep control on the company and sell 49% of the stake to others. You are actually exiting the ownership partially. So you can exit from 10%, 2% to 49% if you want to retain the ownership of the company, or you can sell more than 50% in order to shed the ownership of the company, but still continue to make profits in terms of being a shareholder of the company and getting dividends as well as value for the shares. So both ways it is possible. Exit change of technology. Many a times you are required to change the technology, therefore you exit a business or exit a product. One of the product you can exit, saying that I want change of technology, or the product can be modified. So you are exiting one of the technologies. And then exit an asset. one of the assets in the company which may not be yielding you value or yielding you income, you can decide to sell it. So exit plans are many like this. It goes on, the list goes on, but these are the major areas where you generally exiting happens. So exit plans needs to be like this, or there is what is called as this last one, what we call as succession planning. You have a successor for your company. You need to ensure either your son or your daughter or a friend or someone continues with the business and you are exiting the business. You are retiring from the business. So this is the retirement plan which you need to have in whatever level you want. Finally, when you just cannot manage the business and you don't want to incur losses, you quit the business and go into either insolvency or direct sale of the assets. So up to this, we have discussed about a project report which has major contents of four distinct characters of your project. Now we go into a strategy. Do you want to take a break or you want to continue or you have some questions? Yeah, any questions? Any questions on exit plans? I trust there are, I trust there are no questions.
Sir, actually, one question was there from uh, Mahabaleshwar Hegedeji. Can you elaborate credit rating?
Credit rating is normally done by an external agency who is an authorized credit rating agency. These credit rating agencies do their work of rating economic performance of governments across the world, and then individual enterprises, and then large corporates, small businesses, almost everything. MSMEs are also rated. This credit rating is done by these agencies, taking into account the general performance of the business activity in the market or in the economy. Let's say, for example, the internet service provider business. Now they keep track of all internet service providers businesses and see who is performing well, who is not performing well, why he is not performing well, and in tune with that average performance, they will tend to rate your company in terms of performance. How? Yeah, some interruption was there. So
No, sir. Continue.
a credit rating agency will rate your company in terms of sales, balance sheet, in terms of profits with other companies in the same industry. Whether peer comparison, what we call as, whether there is a comparison that you are really good or really bad or in between in that particular industry. That industry is also compared with all other industries in terms of market share, how much market share this company has or this business has in the economy, and how much market share your company has in this business segment, and accordingly a rating is given. The rating starts from, I think, B, uh, B minus up to triple A and above. So that rating depends on each of the credit rating agencies, and they normally take into account um, this industry performance into account. Then again, it is done for any company which has a borrowing of more than 25 crores. If you have a borrowing of more than 25 crores, credit rating is done. Even otherwise, you can rate your own company every year in terms of credit rating, whether the growth of capital is good, whether your borrowing ability is good, as per the details which we discussed yesterday, 1:3 and 1:4 in terms of own versus borrowed funds. So you can keep on rating your balance sheets in terms of attrition of employees, in terms of capital growth, in terms of borrowing growth, in terms of profit growth. This can only also be done by rating it 1 to 10 in comparison to others. Any further questions? Have I answered you?
Yes, sir. Yes, sir.
Okay.
Yes, sir. Continue.
Can I go further?
Yes.
Okay. Now we go to a comparatively beautiful subject called product objective. What is the objective of your product? The product that you have developed has an objective. What is that objective? Normally, this is not taught in any schools. We have learned it by experience. Okay. Now let us say that you are hungry and you want to eat something. Now you want to eat something immediately because you want to get over your hunger. So what would you like to eat? Would you like to eat a rasam sambar or idli dosa or dal roti or rice dal? Now option is given to you. You would normally prefer to eat a large volume of rice with dal or rotis with dal or idli and chutney and dosa and chutney, which are of large in quantity to meet your hunger. Isn't it? Is this not the way that you do? If you are given a choice when you are hungry, what would you like to have? You want to eat a little bit more of of these kinds of items. Then, when you are at peace, you would like to eat with rice, dal, some sabji also. Sabji is nothing but curry, some palya or curry or the one that's prepared with vegetables. Uh, some vegetables as sabji along with your regular dose of dal and rice. When you are in extremely good mood or relaxed mood, when will you be that? On a festival day, you will always be in a very good mood. So you will try to consume along with rice, dal, and sabzis. You'll go for a sweet. Now, all these three things put together, when will you say, "Oh, I had a very good meal"? You will say that I had a very good meal when you have all of them. If you have one of them, you will say, "Okay, I am satisfied. I am satisfied." But when you have the last one, that is the porridge or sweet item, you say, "Oh, this meal was good." The expression comes, "The meal was good." Okay, now let's bring it back to your own business. In your business, now let us see, why did we eat only rice and dal, and what quantity of rice and dal we ate? Was it equal to the quantity of sweet that we ate? Definitely not. Was it equal to the quantity of sabzi that we ate? Definitely not. The quantity of rice and dal that we eat is relatively larger than the sabzi and the sweet that you eat. So why did you eat rice and dal? Because you wanted energy. You wanted to maintain yourself. So similarly, any enterprise needs to have one product called low value, high volume product like rice and dal, which is of high volume but comparatively cheaper. The, the rice sambar plate is cheaper than one serve of sweet. So that's why the large volume, low value, but large volume. It is of importance to your body being cooled down, or the body should have enough energy. So only for your body or yourself to sustain, you eat dal and rice. So one product in the company which is of low value but high volume is required for sustenance of the entrepreneur. entrepreneur. Entrepreneur is central to business, so he has to survive. So the profits that you make should be ensured that you get a continuous supply of profit to maintain yourself and your employees. That can normally be met by a product category called C, which is of low value but high volume. The turnover is of a high volume, but value will be less, or profit margin for each of the product will be less. Now we go to the next part. Why did you eat sabzi? At least once in 3 to 4 times in a week you will need sabzi, or every day you will need sabzi. The sabzi is required like protein to maintain your body. Now let's imagine you as a factory. When I imagine you as a factory, your body is the factory and your soul is your energy. So energy is produced by C, low value, high volume, dal rice category, and it's your factory churns out energy. Whereas the factory itself needs to be maintained, or your body needs to be maintained. Therefore, you consume proteins or subsidies. So same way, you need to have a B category product, which is of medium profit value to medium quantity that is produced. So automatically that ensures enough profit to maintain your factory, or the enterprise sustenance is assured. Now we come to the last category. When you said, ah, I had a good food, that means you are going to eat the sweet in your plate, and then only you will say, oh, I have a very good meal today. So accordingly, same way, if your enterprise gets one product which gives you high value but you churn out in low volume, so that it delivers maximum profits with low production, then you say my enterprise is functioning very well. So this is called inventory groups and inventory management style in any factory. About last year, I had an inquiry from one of the entrepreneurs who was getting stuck in terms of, he was supplying lighting material to all IT companies, and he was stuck that 3 crores fund he wanted. But unfortunately, his business model contained all A grade products or A category products. All are high value and low volume requirement, and he is not able to get enough money for that because the value volume is so low that everyone is apprehending that I cannot finance this guy. I don't know. I'm not sure. The bankers were scared. Then when I suggested to him the inventory management style, he changed his business style to include low value, high volume products, which is now ensuring him 60% of his business coming from low value, high volume products, and about 20% of the entire business is coming from medium value, medium volume products. His salary structure is completely protected. His employees are completely protected in terms of the regular income, and high value, low volume products continue to be about 20% of this business, and that is churning out larger profit. Now, this is the combination you need to make by learning from your own plate, dining plate, or dinner plate, or a lunch plate, that how you are managing your body as a factory. Same way, your business needs to be managed in ensuring that people who manage the business are sustaining, then the business infrastructure sustains, and then the business makes profit. Any questions at this stage? Any questions? Very, very crucial to understand this. Very, very crucial to understand this.
I think so. You can carry on.
Okay.
Sir, you can see in the chat section.
Yeah, I'm just looking at it. Adarsha Vyaktitva. The person, hello, Mr. Adarsha Vyaktitva. Okay, he doesn't have questions, so we proceed. We go to the.
Sir, good morning, sir.
Good morning.
Hello, sir. Good morning.
Hello.
Sir, the
Ah,
big names, they are cut down price. They're cutting down price.
yeah,
Like a 90 crore company,
yeah.
but still a 12 crore company no, can't survive the business.
Yes.
So, sir, there should be legal action against the
Of
cutting down
course.
price.
In Chakravyuha, Dronacharya was there, Bhishmacharya was there, and Abhimanyu was there. What do you talk about it? Oh, it's market.
Sir. Yes,
Market.
sir.
You can't complain. It's a free market, democracy, you can't complain. You cannot, you
Okay,
have
okay,
to
sure.
strategize yourself and place your product much better in terms of quality and strategize your this thing. In fact, that guy was about to commit suicide. We revived that unit. Today, that unit is working very well. We revived that unit by timely intervention. The day he met me, he said he wanted to die. I said, nothing doing. I corrected it within 1 month. We were able to correct it within 1 month. We corrected our cost production. We corrected our mistakes. We are still sought after in the market now. So we have our required turnover of 10 crores, 12 crores. Okay, we go to the,
Okay, sir. Thank you.
anybody wanting a
Yes, sir.
break?
Thank you.
And also, I would advise you not to get worked up. This is learning that we are taking. We are not here to discuss anyone else's problem in a serious way. All that these principles are required to adjust ourselves or learn ourselves and prepare ourselves to be in a better foundation. Okay. Srikanji, you are handling the part of sending PowerPoint presentations to all the people. I will forward them to you, and you are going to send them to all others, whoever wants.
Fine, fine,
Okay.
fine,
Okay. Now
fine.
we continue with our presentation because we need to continue and complete today's requirement. So we go to the next one. So capacities, this is where we get into the beautiful aspect of how do we look at a project. I'll take you to that, and then we will take you to the, and I will go to the actual presentation of a project in relation to what we discussed yesterday. Okay. Um, I'm giving you live example in terms of a project on the Excel sheet. I think the Excel sheet will be displayed now. 1 minute.
ಸರ್ ಅದು ಸೈಡ್ ಅಲ್ಲಿ ಯಾರು ಪ್ರೆಸೆಂಟೇಷನ್ ಕೇಳ್ತಾ ಇದಾರೆ ಅವ್ರದ್ದು ಹಂಗೆ ಇದು ವರ್ಡ್ ಕಾಪಿ ಮಾಡ್ಕೊಂತೀರಾ ನಿಮ್ ಚಾಟ್ ಬಾಕ್ಸ್ ಅಲ್ಲಿ ಇದೆ ಅದನ್ನ ಸರಿ ಸರ್
Just give me a minute.
ಹಾ ಓಕೆ ಫೈನ್ ಸರ್
Now, any business, when you want to do some kind of a project work in terms of finance, you need to look at these aspects. These aspects is only the sales from all types of products, and then arrive at net sales after deducting the closing stock, after adding the closing stock. And then you should have a detailed working for cost of raw material, cost of power and fuel, cost of direct labor cost, that is the labor used in production of the product, not in other aspects other than production. And then consumables or anything that is used once for its life. That means you have used it and it's gone. So we call it consumables. And then repairs and maintenance of the factory. Remember, repairs and maintenance of the factory in production. So carriage inwards of the raw material that comes into your product, and if you are paying money for that transport, that include it under direct cost or cost of production. So this is how you need to work your uh, costing. So for each one of this, you need to give explanation. Similarly, miscellaneous expenses. After that comes selling and admin and general expenses. So these are all called indirect expenses. All the above, these are called direct expenses. So these are all direct expenses, and this is called indirect expenses. For all of them, you need to give separate working for the product, including sales. Sales and closing stock and net sales, you need to give a separate working. Remember, you need to give separate working for each one of them. So these are called direct cost, and this is called indirect cost. And then we have other expenses like interest and depreciation. Interest and depreciation are also expenses, but they come only after you make what we call as earnings. At first stage, we say sales minus direct expenses minus indirect expenses, and then you arrive at a profit called EBITDA, and then only the interest and depreciation are accounted and tax is accounted. So it is very important for you to arrive at profits before you pay interest, you pay depreciation, and then you pay taxes. Before you pay these three, what is the profit you are making is very crucial for you to understand. Okay, so we will go one by one how we arrive at each of them and how we look at our production. Now, this is a unit called milk production, milk processing unit. So this is a milk processing unit, and the machineries procured have a capacity to process around 12,500 liters of milk every hour. So they get into one batch of 8 hours. So approximately 1 lakh liters is processed every day. And I just put the liters. So this is the machinery capacity. What is determined is the machinery which I purchase has a capacity to process 1 lakh liters of milk per day. On a 300 days operating cycle, I can process around 300 lakhs or 3 crore liters of milk per year. This is the capacity determined by capacity of the machine or technical capacity, what I told you in the morning. So installed capacity, what we call, or technically installed capacity is 300 lakhs per year, or 3 crore liters of milk will be processed every year. So we require a 2 acre land, and we require around 4,500 square meters of constructed area in the form of shed to house all the machinery, plus cold storage, plus receiving area, and various other aspects which we will discuss later. Now, the technical capacity which I talked about in the morning is this. You have 3 lakh liters processing per annum at the rate of 1 lakh liter per day, operating for 300 days. Why we operate for 300 days is approximately 54 days or Sundays or one weekly holiday, and then remaining 12 to 15 days or an operating arrangement when we may stop operations to clean the factory or make repairs or any other exigencies that you have to operate. Generally, we take it at 300, but the optimum would be 270 days. 270 days would be optimum. Now, we go to another slide we have to work out, as we said, first we have to work out sales. Now let us look at how we work out sales. Now, installed capacity of milk, raw milk that is coming into the factory is left blank. Now, I will incorporate it as liters per day. It is about 1 lakh liter per day. Now, I incorporated 1 lakh liter for 300 days. So 300 lakh liters per annum is the installed capacity. This is called installed capacity. Now, owing to various reasons, I am able to use only certain part of the installed capacity. So that is called utilized capacity. So in the first year, normally, when the unit is new, it takes time for us to establish the factory, plus it takes time for us to operate the factory for the first time, make corrections to it, and bring out the product and then sell it. Therefore, we may be able to only go up to 30% to 45% of the capacity. Now, since the entrepreneur said he will be able to sell 45% in the first year, we have taken 45%. Generally, it will be 30 to 33% only in the first year. Generally, always remember it should be 30 to 33% in the first year. Don't ask why and what. You will experience it, because you need to give time for your factory to show that it can deliver a correct product of a good quality product acceptable in the market. Therefore, there is time between first point of production to acceptance in the market, which requires changes. Therefore, it's only 33% maximum that is possible in the first year. People are anxious to show very high production in the first year. That is what I have seen tendency among all new units. They have a tendency, they have a anxiousness to show very good performance from the first year itself. But that is not true. It is something like you are asking your just employed girl to become a CEO right from day 2 or day 3 or day 4 of her employment. It is not true, it is not correct, it is not fair. You need to allow your your factory to perform in a way that the product that you generate is marketed well in the accepted well in the market. So 45% in the first year, 60% in the second year, because that's an establishing stage where employees get used to and your finances come into picture. Therefore, you are able to get into a groove to some extent. Therefore, around 60% to 70% will be the best level that you can operate in the second year. From third year onwards, you can straight away go to 80%, but here they have taken conservatively at 70%, because milk procurement system needs to be properly worked out. Now comes product planning. Now I need to plan a product. Okay. Now you see, we discussed about A category product, B category product, and C category product. Now we see how we are going to decide about it. First thing is, out of 1 lakh liter of milk, I need to sell a part of the milk at a high product, a high value product. So paneer I have decided. So I decide to take 15% of milk will be allocated for paneer production. Therefore, 20 lakh liters of milk will be used for paneer production. Then curd is under B category. Curd will be kept for a longer period of time, or shelf life is more. So I allocate about 20% of, sorry, I will allocate 15% for curd making. And I am not interested in going for coa production. I will go straight away for skimmed milk production and cream separation and skim milk marketing. So I dedicate about 94 lakh liters of milk in the first year towards skimmed milk powder making, butter separation and ghee making, and then milk also, skim milk also. So ultimately, I'm left with 94 lakh liters of milk in the first year for production of this. This product comes under A category, where it's of lower value but high volume. Now, this comes under medium category, this comes under high category. So I tried to place it in such a way that I have all the three products to take care of my unit in a reasonably a decent way to ensure that I make profits. Now, once I allocate this, now you see the magic that is happening. First is I allocated 94 lakh liters of milk for this cream separation and milk powder making. So out of 94 lakh liters, 4.25% is the fat. So total fat available is 4 lakh liters. And in that 4 lakh liters, I separate fat, that is butter, to the extent of 77%. Remaining 22.5%, I leave it in the milk so that the cream in the milk is sold as either a skim milk or it is further processed to produce milk powder. Now, skim milk, I have, after removing the fat, I'm left with 91. Skim milk, I have 91 lakh liters, 91 lakh liters of skim milk, and in that 1% fat is maintained. Losses in skim milk is this, and I'm left with 90 lakh liters of skim milk in the project. Now, paneer production is, for every kg of paneer I produce, I need 7 liters of water, 7 liters of milk. Therefore, I am producing around 2,90,000 liters of kgs of paneer from my factory. And then I derive a sales value of 9, 9 crore 71 lakhs from paneer. And from Kova, I don't have anything. And then I go to cream production. I have produced total of 3 lakh 10,000 liters of cream, which I allocated for butter. Cream used in butter production is 3 lakh 10,000, and then butter used in ghee making is 1 lakh 39,000. Don't bother about these figures because this has been grossly modified to protect the identity of the project. Don't go by this number. Look at the procedure. Don't go by the number, go by the procedure. This is how, for each product, sales value is arrived. You see, for sales value of butter, sales value of ghee, sales value of curd, and then together I make a summary of that. I get sales from paneer, sales from butter, sales from ghee, sales from curds, sales from skim milk powder. Totally, I have 44 crores sales. So this is what the figure we require here. 44 crores is the sales figure. Now, this is how you arrive at sales for each of the product. You try to do what is the capacity used, what is the conversion rate, what is the final product you have developed, and what is the rate at which you are selling, and income or revenue or sale from each of the product is arrived, and then total of such product is made to arrive at total value of sales. Same way, we go to the next item, that is cost of raw material. The raw material here is milk, so only one raw material. So we are able to arrive at cost of raw material. The same thing is brought down here in the same form of 37 lakh, 37 crores 80 lakhs. Then we come to the next stage where we try to determine power and fuel, direct labor cost, consumables, repairs and maintenance, in carriage inwards and miscellaneous. All these things are arrived at in terms of processing expenses. So processing expenses are arrived for each item. Power and fuel, milk processed per annum, 13 lakh 50,000 liters in the first year. So units per liter of milk, about 0.15 units are consumed because the milk gets heating to the level of about 80 to 90 degrees or sometimes 95 degrees as a part of pasteurization, and it is heated at very high temperature for a nanominute or nanosecond. Therefore, the power consumption is calculated for each of the unit and then for the entire quantity. Similarly, direct labor that is required 1.5 man days for 2000 liters. How did I arrive at this? 1.5 man days means about 12 hours of work of a particular person at 8 hours a man day. So 2000 liters being handled over 12 hours, or per hour one person is handling 125 to 150 liters of milk. Is that possible or not? It is something like he handles 2 liters of milk every minute, which is reasonable and can still be rationalized by bringing it down. I can bring it down to one man day, sorry, 2 man days for 2000 liters. So I can reduce the requirement of labor here. So you need to rationalize the labor requirement in this fashion. Remember, this labor is only for production, not for administration. We come to that separately. Then other consumables, as we see here, projections in profitability, direct labor cost, consumables. In case of milk, we have the consumable in the form of just a moment. So consumables in case of milk processing can be packaging or sometimes lot of water is required in cleaning and other activities. Uh, Chemicals are required. So you can see all are accounted. That means packaging is accounted, chemicals are accounted, and then water is also accounted in this. So total consumables will come to 405 plus 68, 473 lakhs. And then freight inward. Freight inward is the milk needs to be transported in a cold chain. Therefore, the cost of transportation is high. And accordingly, we have accounted for transportation costs here. Average logistic cost is 2 rupees per liter. Accordingly, that has been taken care of. Machinery and equipment, repairs and maintenance, it is about 15% of the cost of the capital goods of the factory. So approximately 15 per 10 to 15% of the cost of the entire factory will be required in the form of maintenance and repairs. So I will approximately take it as 150 lakhs here, and that is given a 2.5% increase every year. This formula is fitted, so every year you can give an increment of 2.5% on prices as well as the cost, as well as the price of the finished goods. So total processing cost is arrived at, and that is accounted in our thing. So repairs and maintenance is accounted, carriage inwards is accounted, miscellaneous is accounted. So now we have total direct cost available here. So 48, I mean, don't go by the figures. These are not the figures in the project report. These are all modified for the purpose of protecting identity of the project. I'm only showing you the contents of the calculation and how to do it. Okay. Now, any questions so far?
Sir, will you be able to share this Excel by any chance?
100%. 100%.
Okay, thank you.
We will be able to share by protecting the identity of the original project. Uh, no issues at all. You will get it. No problem. See,
Okay,
I'm
so
giving you
you
simple techniques. I'm not trying to make your life complicated. I'm making it very simple. This is how you learn to do it yourself. Don't go to a CA to get this. You can do it yourself, and you are capable of doing it. So you need to learn
Yes.
that. Okay. So we go back
Yes.
to the
Thank you.
presentation. There are no questions.
Sir, Srini here again. Where do we put damage and those things?
Sorry.
Where do we put damages or
Returns, sales returns.
returns or damages, scrap, like mimic or wasted or something like that? Where do you put that?
You can include it as a separate item under direct expenses. If the product is completed and then lost,
Okay.
you can include it under direct cost,
Okay, sir. Yeah.
and not under indirect or any other head. And again, it also depends. If you decide to recover that particular loss over a period of time, you can also say that I want to capitalize it and I want to recover it over a period of time. So you can also account it directly under balance sheet. Expenses to be written off over a period of time. It can also be done, but then it is subject to CS permission and Indian accounting standards permitting you to do it.
Okay, sir.
Um, I don't know whether we may cross the time limit. We have already crossed the time limit. We still need a lot of time. So are you guys in, or you are going to push out at 12:30?
We are with you. We are learning.
What about Shrikantji? Is okay? Yeah, it's okay. We'll continue. So now, once this is done, we come to a category called administration expenses and sales expenses. We will see that 1 minute. I'm having this. Sorry. Now we come to what we call as sales administration expenses. So we have a style of presenting administration team. So we need to work out what is the team that we have in order to work out the total expenditure for the manpower at administration level, not at production level. Okay, production level staff can be separately accounted and again brought under direct cost. There is no rule like that. Just for the ease of it, I am putting all the expenses under sales and administration. Sorry. Now, the project requires a general manager whose salary I have indicated, manager for production operations, manager for marketing operations, and one team of administration and sales. Now, you can divide your entire unit according to it, and any other aspect can be included in this, and salaries can be estimated for them and include it under annual costs. This comes under indirect costs accounted here. I've removed them, but now I'll bring them in. I told you, don't go by this particular figures. These figures have been totally modified. Okay, totally modified. Don't bother about that. Only look at the principles of accounting or principles of preparing a cash flow statement. Generally, we prepare a cash flow projection for 8 years period. So this you should remember that it is always prepared for 8 years period. Then we have marketing and distribution expenses, which is 1 rupee 25 paisa per liter, and marketing commission around 2.5 rupees per liter. So marketing costs are accounted at 5 crores per annum. Then we have what we call as administrative overheads. For this, we have a split up administrative overheads, which includes these items: telephone or communication, travel and conveyance, office maintenance, printing and stationery, post and telegraph, maintenance and repairs of office, office and unrelated to production. Anything that is not related to production, if it is repaired, it comes under this. Then insurance and miscellaneous R&D expenses are all brought under other overheads, and accordingly, your processing and indirect expenses are calculated here. All these indirect expenses are taken into your statement somewhere here. Okay. Now, once this statement is ready, up to here, when we arrive at EBITDA, you can calculate interest payment, if any, depreciation, if any, and then taxes, if any, deduct taxes and everything, all these three items from EBITDA and arrive at net profit. And once net profit is arrived, we want to calculate how much cash is left with us. We add back depreciation and we add back interest to say I'm having a good amount of cash with me. Let me take, I will close this particular chart and take you to the actual one where I'm showing you, but keep it confidential. I won't be able to share that chart with you. I'll share a better chart with you, but certainly I will show you what that chart means for the present business. Let me show you that. Now, this is a real one. So I am bringing you to the projections in profitability. Now, I told you I had modified a lot, and accordingly I have removed the name to protect the identity. Now, this particular project has a EBITDA of 156, 527, and accordingly up to 10 crores over a period of 8 years per annum. So this is what the profits will look at, and the company will also have substantial cash in hand to repay bank loan or anything like that. Then we come to what we call as analysis of a project. Now, in the analysis of the project, first level we take is arrival at what we call as present value of future income. Present value of future income. So many of you may wonder what this is. Suppose you keep 100 rupees deposit in a bank. After
Sir,
1 year,
sir, can you share the screen?
oh, I'm sorry. I'm really sorry. I'm sorry. I forgot. I'm sorry. Now you are able to see? 1 minute. Sorry. 50 figures that we had worked out. You are able to see?
Yes.
Yes, yes.
Okay. Now this is how a final projection statement will look at. What we do is we take it over to an analysis sheet called IRRM payback. Here we do a different kind of analysis. So first part is I want to hide this much from you up to 23 row. I am going to hide it from you, and I am only taking you to the operational cash flow and analysis of it. What we do is the entire operations is yielding us certain benefits at the end of every year. So these benefits at the end of every year is brought down by a mathematical formula to today's value. Suppose I get 10,000, 10 lakh rupees, 10 crore rupees in the year 7. What is its value today is what we calculate using a arithmetical formula. We call it as discount factor, and at 23% of discount factor, yesterday we learned about it, higher the interest rate, higher the risk provision. So at 23% discount rate, although I earn 10 crores in the 7th year, its value today is only 2 crores. So same way, at the end of each year, we have the value as on today of the profit that we make in that year. Suppose I make profit at the end of 1 year at 100 lakhs, its value as on today, that is the first day of 365 days, is only 76 lakhs by an arithmetical adjustment. This is nothing but today if you keep 76 lakh of rupees, at the end of the year, at 23% interest rate, you will get back 93 lakhs. Or 93 lakhs if I give you at the end of the year, its value today is only 76 lakhs. Same way, if you have 3 crore 9 lakh rupees with you and then invest it at 23 lakhs, at the end of second year, 3 crore would be valued at 4 crore 64 lakhs. Ulta is, if someone gives you 4 crore 64 lakhs at the end of second year, its value as on today, I mean today, is 309. So all the values of all the years as on today, we total them. We total them. When we total them, we get value that you have earned in different years totaled as on today. Is that okay? Is that understand? Is that understood? Okay. Now we have one issue with the last year or the final year. Now, if you look at the final year, the value given is much better, much higher than seventh year. 8 year income is shown at a very high rate than the seventh year. This is what we call as the terminal value or the final value of the project. See, the project is an eternal affair. It is eternal. It cannot say that you are stopping at the end of the 8 year. 8 year we have an income. That income is actually at the end of 8 year we have an income of only 10 crores, but we convert this 10 crores into what we call as terminal value or eternal value. That means this money, 10 crores, it will be yielding in the 8 year, what is its lifetime value is what we calculate in the last year. So what we do is we divide this using the formula which I gave you yesterday, or we calculate, we what we do is we convert it into income capitalization method at 23%. So it becomes 45 lakh 69,000 as a terminal value in the 8 year. Remember this, that terminal value calculation is the final year income or the 8 year income is divided by the interest rate or the discount factor you are using. You can see the formula in this. So L21 divided by interest rate. So the final value is given here. Is that understood or any confusion? Why we use terminal value is to show that the project does not end at 8 year. It has got a terminal value or performance that goes on for a period more than 8 years. So we arrive at a value as at the end of 8 year to indicate as a terminal value. These are all permitted methods of arriving at values. Is that okay? Understood? Terminal value is arrived at by adopting income capitalization method for the income in the last year. For the net income in the last year is divided by interest rate to give the terminal value. This is permitted by most of the judiciary in accepting the value of a company at the end of its cash flow period. Cash flow period is 8 years, but terminal value is arrived at in terms of this thing. Now, what we do is we arrive at total of all the present values of different years and then arrive at a present cumulative value of almost 29 crores or 30 crores. Let us round it up as 30 crores. Now, if value of my project is 30 crores, how much should I invest? Is the question mark we do. So how much should I invest? Generally, I would like to take 33% of the value out as a risk in this business. Therefore, I try to calculate 29 into 33%. This is the risk. So risk free investment will be 29 minus this. So approximately 19 crore 50 lakhs I can invest in this project. This is what these calculations tell you. So 19 crore 50 lakhs is the amount that you can invest. Now we will try to see how we calculate it for in a different way by physical calculation on a sheet of paper. Now I'm switching over to a sheet
Sir,
of
sir,
paper.
excuse me, sir.
Yeah,
Sir, at this end, can you please elaborate a bit more from the internal rate of return? Because you said
I'm
that
not going into internal rate of return. Please don't go.
most judiciary say, as per you, like in the last year we divided by the internal rate of return. So
No,
we
no,
get
no, 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 no. Did I use the word internal rate of return? I said discount factor.
okay.
See, don't get confused. I'm not discussing this aspect at all. I'm hiding this.
Yeah, yeah.
I told you I'm hiding this. Who told you discounting an internal rate of return? No,
Okay. So
it
so
is
with the
discount factor.
okay.
सी
So
देखिए एक मिनट मैं आपको इसको एक्सप्लेन करता हूँ और एक बार एक्सप्लेन करता हूँ
hmm,
कि समझिए आप एक बिजनेस चालू किए हैं क्या ये सिर्फ 8 साल के लिए चलेगा या 8 साल के बाद भी चलता रहेगा
no, it will
इट
run
विल
till
रन
its life. Yeah,
यू आर कंफर्टेबल विथ इंग्लिश और हिंदी
yeah, both.
बहुत ओके चलता रहेगा ना
Right.
मगर आपने क्या कर रहे हैं आप अपना एंटरप्राइज को वैल्यू कर रहे हैं इसीलिए आपने 8वें साल तक कैश फ्लो निकाले और प्रॉफिट निकाले मगर 8 साल के बाद भी ये कंटिन्यू रहेगा इसीलिए वो कंटिन्यू रखने से उसका वैल्यू 8वें साल में क्या होगा ये हम डिराइव करते हैं बाय यूजिंग द टेक्निक कॉल्ड इनकम कैपिटलाइजेशन व्हिच वी लर्न yesterday. What we do here is we just divide we just divide last year income or the 8 year income with 23% to arrive at terminal value or eternal value. अगर 8 साल के बाद भी अगर ये बिजनेस कंटिन्यू करता है 8वें साल में इसका कीमत 45 करोड़ का होगा करके एस्टिमेट करते हैं वो एक्सेप्टेड मेथड है दैट ओके
Okay. And after that, you are adding all the cumulative present flows.
present value.
Yeah.
So I arrive at total cumulative present value. This is the actual value of your project, actual value of the project. In case you implement and perform this way, in case you perform this way, this is the value of your project. If this is the value of your project, how much should you invest in this project? सपोज आपको मैं बोलता हूँ मेरा ये मोबाइल फ़ोन का कीमत है 30,000 आप कितने में खरीदोगे आप नेगोशिएट करोगे या नहीं करोगे
बिल्कुल बिल्कुल.
क्यों करोगे वाई आर यू नेगोशिएटिंग इट
Because I get so that I can get a good value.
नो यू आर नॉट श्योर व्हाट द कंडीशन इज
Maybe yes,
यू
right.
आर टेकिंग रिस्क
Mhm.
नया नया मोबाइल में भी रिस्क रहता है ना इसलिए वो वारंटी देता है
Correct.
मगर ये मैं यूज फोन दिखा रहा हूँ तो आप क्या करोगे इसमें रिस्क है ना इसीलिए रिस्क निकाल के आप एक कीमत कोट करोगे बराबर है ना
Right, right.
इसी तरह आपका प्रोजेक्ट को अगर 30 करोड़ रुपए का वैल्यू मिलता है जिसमें आप रिस्क निकालोगे क्या 8 साल चलता है ये फैक्ट्री कुछ भी सब कुछ ऐसा ही होगा नहीं होगा ना
No.
तो इसीलिए हम 33% का रिस्क बाजू में रख देते हैं फिर अपने को एक फिगर आता है वो 19 करोड़ 50 लाख 19 करोड़ 50 lakhs आता है This is the maximum money I should invest or I should spend on establishing the factory. This is the money I should invest in my factory or in my establishment or in infrastructure. ठीक है?
Okay. Mm-hmm.
ये इसको हम कैपिटल बजट कहते हैं. ये जो 19,50,000 है ना, दिस इज कॉल्ड कैपिटल बजट. अगर आपको अपना कैपिटल बजट मिल गया बेस्ड ऑन डिस्काउंटेड फैक्टर ऑफ प्रोजेक्टेड कैश फ्लो, सब कुछ प्रोजेक्शन ही चल रहा है, उसके बेसिस पर 19 करोड़ 50 लाख का रिक्वायरमेंट आपको है. आज अगर ये फैक्ट्री डालना चाहते हो तो आप 19 करोड़ 50 लाख तक ही प्लान कर सकते हो. उसके बाद अगर प्लान करते हो आप रिस्क बढ़ा रहे हो, है ना?
Okay.
बराबर है ना? इज दैट राइट?
Right, right.
Yeah. Now we go back to one more sheet, beautiful sheet, is called factory development. Or now I use that 19 crore 50 lakh budget which I got in planning my investment. 19 crore 50 lakh is the budget I got, capital budget. I go for what is called as investment setting. This aspect is called investment setting. So now I allocate this 19 लाख 50 हजार or 19 करोड़ 50 लाख or 19 crore 50 lakhs amongst different important aspects of my factory. Land is required 2 acres, 2 crore इसके लिए allot कर रहा हूँ. I am allotting 2 crores to land. Then other requirement like compound wall, storm water drain, roads, landscape, everything I allot 21 lakhs. Water supply system I allot 5 lakhs. Then civil works I require about 4,500 square feet of construction and allotting 4 crore 50 lakhs. Then I require electric installations. I allot 55 lakhs. Then I require all the machinery for which I allot 9 crore 50 lakhs. Then I have other allocations like contingency. I have 40 lakhs, and I also try to keep about 250 lakhs aside for my working capital. Remember, this is investment which includes my money also. I just don't bother about this. Remember, I require 2 crore 90 lakhs as a liquid cash in my hand to begin my operation. So totally, I have allotted my capital budget of 19 crore 50 lakhs among all the required assets for the production and processing of milk and milk products. So now you need to look at is the capital budget is allocated mainly for productive assets. The productive assets are 4 crore 50 lakhs and 9 crore 50 lakhs. Together it is 13 crores plus 3 crores for activities related to production. So 17 crores I am allocating for productive assets and 3 crores I am allocating for non-productive assets or directly not contributing to production. They don't directly contribute, but they contribute indirectly. Is that fine? Any questions?
I have a question, sir. In IT kind of industry, where in IT industry, in agriculture, a lot of the money is actually spent on human resource. You call them productive investment, or how do you want to? It's not an asset, physical asset, right? So, what do
Absolutely
you?
true. So now what happens in case of an IT industry is we convert up to the point of launch of your product commercially, all the expenses incurred, including human resources, as capital expenditure.
Sir,
Okay,
sir,
thank you.
ಇನ್ನೊಂದು 15
All the
20 ಮಿನಿಟ್ಸ್
expenditure. That
ಸರ್
means
ಆದ್ಮೇಲೆ ಫೋನ್ ಮಾಡಿ ಹೇಳಿಲ್ಲ ಸರ್
commercial launch of your product. Commercial launch means from that day you start making profit. So up to the point of commercial launch, whatever you incur in terms of expenditure should be classified as capital expenditure. Or
Okay.
what I showed you here in the presentation, this expenditure, 19 crore 71 lakh. This includes all expenditure up to commercial launch or commercial sale of your product. This
Okay.
case. So here, in your case, nothing will come in terms of machinery. You may get little bit computers, laptops, peripherals, and all that. You may get ACs. You may get room partitioners and other things. But your major expenses will come here in the form of, you can give division here, other expenses, human resources, technical expenses for so many months, so much salary.
Thank you, sir. Thank you.
Okay, any other questions? Any other questions?
For Seema again, sir.
For the time being, I presume that there are no questions and I proceed. I proceed to the next aspect called working capital.
Sir, please proceed.
Okay. Working capital is the money that you normally require to run your operations or day-to-day working of your factory. It is like you eat rice and dal to keep your energy in your body, and then you earn you energy is used again to produce something and earn money back. So working capital is something like everyday operations money required for everyday operation. Generally, this is called, this is calculated by three methods. First one is called turnover method. Turn one minute. So you are able to see my writing camera.
No, sir. Still the Excel sheet
In
is.
my, in the other one, no, you are not able to see one. You'll have to stop sharing. So first method is called turnover method. You are able to see it properly?
Yes, sir.
Turnover method. Second one is called inventory method. Now, since most of you do not have what I call as sales beyond 24 crores, only first method is applicable. Anybody having sales beyond 24 crores, then this method applies, inventory method. Okay. Now it is so simple that Reserve Bank of India says that under turnover method, it is 25% of sales is required as working capital. It's very simple. Total 25% of sales, that's up 24 crores, means 6 crores is working capital required for this business having a sale of 24 crores. So 6 crore means in this you need to bring 1.5 crore is yours and 4.5 crores is banks. So 25% and 75%. So this is the only method that is applicable to you. Kindly ensure that this is the simplest way you can calculate working capital. We'll go to our presentation. If that is clear, any questions here?
No, sir, no.
Is that clear?
Yeah, it's clear.
So this is for taking a working capital loan in the bank. Unless
Yes.
you put that 25%, bank will not give you the
General
75%.
bank insists 25%, but today you can negotiate them between 15 and 25%.
Okay. So the RBI guidelines is for the banks. right? That 25%.
It is for when it is for bank, it is for entrepreneur also.
Okay, okay.
These guidelines are for bank. It is for entrepreneur also. Okay. Shall we go ahead?
Yes, sir, we can go ahead. Yeah.
Okay.
Yes.
So we go back to our presentation slide. So I have still five more, so many slides, but let me see how best I can take you to the conclusive part of it. So we discussed about capacities of the. Oh, I'm sharing or I'm not sharing. One, I made a mistake. Just give me some time. I'm coming back to you. So we just now saw installed capacity, utilized capacity, and allocation of capacity. For different products, the utilized capacity is allocated. Like we had utilized capacity of 45% of the milk, and then we allocated milk for paneer production, butter production, and curd production, and skim milk powder production, like that. We allocated them. But the whole objective of capacities is to see that whatever infrastructure you have created is used to maximum extent. Suppose you have a manpower in your IT company, how do you put manpower to maximum utilization? If someone is sitting idle, can we put him in R&D to develop a new product? If manpower is not completely used for a particular purpose, we can deploy it for any other purpose that is beneficial to the company. So how do I maximize my infrastructure is very crucial in this particular capacity management that we have. Now, enterprise, as an enterprise, we need to look at location of supply chain, identifying the risk. There is, see, normally insurance is very important part of your enterprise. You know, in Hindu mythology, we have Ashtadikpalakas. So for your enterprise, there are Ashtadikpalakas. All these include fire, water, Varuna, Agni, and Yama, who is like competitor, and Kubera, who is financier. So you have everybody. All these Ashtadikpalakas are there for your business. So you need to take insurance for your business, and then human resources planning is very crucial, and registrations and permissions are also equally important. Let me give certain examples later. See, one of the most crucial aspect of your business strategy is planning the moratorium. So most of you will be sitting very anxious, very excited to give the bank a plan, saying that, sir, within 6 months I'm going to start repayments. Within 1 year I'm going to start repayment. Within half a year I will start repayment. Oh, so much promise that you want to make by projecting a unnecessary and unwanted and excited, or what you call as unachievable projections you try to make, and then end up in soup. We had one unit in gherkin production. This guy had been sanctioned 6 crores of loan, of which 4 crore was for factory and 2 crore was for procurement of raw material or working capital. So he told the bank that he will complete the factory within
Sir, ಇದು
6 months
repeat
and start repaying by the seventh
ಅದು
month. So
ಅವ್ರಿಗೆಲ್ಲ
the
ಸರ್ವಿಸ್
everything
ಇದೆ
was
ಗೊತ್ತು.
documented and
ಸರಿ.
everybody agreed, including the bank's technical staff also said, okay,
ಹಾ.
this guy
ಅಲ್ಲ
will pay after
ಇದ್ರದ್ದು
6 months.
ವೈದ್ಯಕೀಯ ರೆಕಮೆಂಡ್ ನಡೀತಲ್ಲ ನಿಮ್ದೇ
Now,
ಅಲ್ಲ
after 6 months, the project was completed, no doubt. But where was the raw material? He wanted weapons to be purchased or some agriculture vegetables to be purchased, and the vegetable was not available in the market. Now, what happened to his farmers? He's not able to
ಸರ್
purchase the raw material and he's not able to use his factory, but he has to go on paying the installment to the factory, to the bank. So, what he started doing is he started paying it out of the working capital. There is no production, there is no sales, but working capital is being utilized to repay the bank loan. Ultimately, by the time the season came and he had a production plan, all his working capital had been looted in the form of installments. He did the working capital. So the unit became sick in within 1 year. And in the 13th month of the factory of sanctioning loan, the bank sent him a notice asking why his property should not be auctioned or his collateral property should not be auctioned. Now imagine what kind of mess this person has created for himself. Within 1 year, without a single product being produced, the entire assets are going for a auction. Now, this is what we call as moratorium planning. This is very crucial for you. You need to clearly map what is the planning stage, what is the loan procurement stage or fund mobilization stay period, and then what is the some material procurement period, what is the installation period, and totally how much time will be required to have first production, after post production, test marketing, and after test marketing, commercial marketing. So the period from the conception of the project or period from the point of sanction of the loan till you get into commercial marketing is what we need to know as moratorium period. You need to get minimum 18 months moratorium for any of the projects because there is a test marketing involved and the product needs to be tested in the market for its acceptance and movement. So you need to be very careful when you approach a financier or any person. Your moratorium period is very well accounted for, and you have a comfortable moratorium period. I have a case in which a guy installed a organic coconut oil production unit or cold processing unit, and he made the same mistake of committing to the bank that he will start repaying in the seventh month. Luckily, I have a habit of traveling around, so I go around and I saw his factory, and I just entered it. After entering, I got into a small conversation with the guy, and I saw that the operations were not at the required level. And then I started discussing with him, and I told him, "You have committed a mistake financially." Then I explained to him how he had messed up his moratorium period. He agreed with me. Then I wrote a letter to the bank then and there and gave it to him and asked him to give it to the bank. And I have quoted some RBI circulars for that, saying that a proper moratorium should be given to a small and micro enterprise. And accordingly, we got the case with the bank, and then bank agreed to extend the moratorium up to 18 months. And the company was able to recoup himself and able to repay after the 19th month in a regular fashion. So one of the most important thing is don't be anxious, don't be excited, don't be under compulsion to commit what you cannot do. Please be straightforward in business to ensure that you get a good timeline or moratorium, which includes all these things like backward and forward supply chains, trial production, testing, marketing, and capacity utilization. So, my dear friends, as we come to the close of this lecture, I would like to show you this graph. This graph shows the life of a business or life of a product. It applies to life of the product as well as life of a business. It has an initial lag phase, what we call as when the performance is of a lower order, it may even go below zero. But this period quickly turns over and convert itself into what we call as growth phase. Something like a child, a infant is highly dependent on you. It is taking a lot of your time and it's not giving you so much time for any productive this thing. So it is only negative, and then it starts learning, talking, walking, and then programming itself to be in the market. And then it joins the first standard. When it joins the first standard, you see it starts communicating with its competitors in the classroom. It competes with in the classroom, starts growing. It grows, and then it becomes a college student, and then it starts getting a job, starts earning money, earning more money, and then it hits a plateau. This is where you should understand whenever your sales are down or whenever your sales are flat, it is not growing. You should understand the end of your product is coming near. So you need to either change or you need to revise your product. In case of cell phones, this period is very short, as short as this level. So that's why every year you see everyone coming out with a new product. So this stage in case of cell phones is somewhere here. So every year it keeps changing. So this is where you should be very scared. And then at the end of stable phase, you see that sales fall or the product acceptance is coming down and it goes down, 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 and out. We call this phase as the log phase, stable phase, change phase, or decline phase. Now we come to the change phase. This is exactly where you think of planning a change in your business line or business product or bring about improvements in your product. So this is a change certain period. The maintenance expenses start increasing. Its performance starts decreasing. So what you do is here you change a car or where you change a car or you make modifications to the car so that this cycle is repeated. So this is what I wanted to present you today. I think all others I have covered yesterday. So thank you very much, and I'm stopping here. If you have any questions, I'll take it. So I wish you all the best.
Sir, one quick question over sir. Sir,
Yeah,
I would like to contact you personal. Can you please give the details, your phone or mail ID?
in your screen.
Yeah, thank you so much. Thank you so much. It was a great
My
session.
email ID will be shared by Srikanji. And
Okay.
again, let me tell you, if you have to call me, let us message me
Sure,
first.
sure.
If you
Sure,
don't
sure.
message me, I don't take the call.
Yeah, I will request that. Yeah, thank you.
Sir, Steven here again. One question.
Yeah, go ahead.
Yeah, how do we scale it up? In the sense, first we want to see the our market research, market reach, then we can scale it up to the next level, then to the next level, right? We can do it in a multiple scaling process.
Yeah,
Financially, how do you call it as a scaling capital, and how do you see that as a process?
scaling up of business or product.
Yeah, business.
Okay, scaling up of business is a art. It's a technique. One of the simplest ways how you plan your capital growth and sales growth in an integrated way. Now, let's say I have a project where I have only 10 lakhs left with me uh, for uh, for my working capital, and nobody is investing today. My product is a nutrition bar. Okay, the product cost for me is 18 rupees, and my price is 35 rupees. So I'm making 17 rupees profit on every unit of my nutrition bar. Nobody is willing to invest, but I'm left with production of around at 20 rupees. I produce around 5 lakh units. That right? No, 50,000 units. Now 50,000 units, I will try to sell it off within 1 month because I need to replenish my stock. So what I do is I try my full steam to sell off entire 50,000, but I will succeed in selling only 20,000. So 20,000 units when I sell, I will have made at the rate of 15 rupees per unit, I will have made around 3.5 lakh rupees of 3 lakh rupees of profit because my margins are 15 rupees after recovering the cost. Remember, I don't have any stock. Now that 3.5 lakh rupees, initially I flow into my capital. So my working capital now becomes 13 lakhs. So second month, I improve it to 16 lakhs, and third month to 20 lakhs, fourth month to 25 lakhs, and by end of the year, I will have my own working capital of 50 lakhs. Now, when I have a working capital of 50 lakhs, which I pushed up on account of my own effort, by the end of the year, I certainly will have the courage to employ marketing guys or dealers and all other things because I have been moving around in the market and now I am able to scale it up. Now, in order to provide initial push, I am because it's a nutrition bar, I am contacting all hospitals one at a time especially the hospitals that are integrated units, where I demonstrate to them my product and I tell them that my product price is 50 rupees and they can take 15 rupees profit. Give me only 35 rupees. So MRP is 50. The guy who sells it can take 15 and give me 35 rupees. So this is how I would like to scale up over a period of time. But again, it depends on your product and how we can plan a scale up plan. So it requires financial planning before you take up any scaling up of your sales. Very importantly, your working capital. You need to provide for building of your working capital, and then only you can plan scaling up in stages. Am I okay? Am I clear?
Yes, sir. Thank you. Thank you so much for
In
explaining.
each stage, you look at your finance availability as working capital. If you have working capital, you can scale up immediately by hiring so many people. But if you do not have working capital, you need to go very, very slowly, but with your own efforts, you should be able to. Initially, do not think of something called I need a front shelf, back shelf in a mall and all that. It is all bullshit. You push yourself with the product. Be confident about your product. All that you need to know is your product well. You should market your product in a manner it deserves a respect in the market, right? All the best to you, sir.
Thank you. Thank you.
Satish sir, I think we are
One,
towards the end of the session,
Yeah.
so we
once,
are already at par the time. So
Ajay Kumar
I
Naidu ji.
think we can now take
yeah, one question, sir. One small. Uh, in case of a startup, how will you do the valuation? I know it's a big topic, but then what is the most appropriate method in the present market scenario?
Okay. Now, first thing is you divide your entire startup into phases. What phase you have incurred how much. So you have to divide it into phases. Generally, we do this for any startup. We divide it into phases. First phase, second phase, third phase, fourth phase, fifth phase, like that. We give as many phases as possible till the final product is ready. Now, for each phase, you go on adding the expenditure you have incurred until you reach, until you reach, until you reach the commercial stage. Okay.
Okay.
Now, the moment your product is acceptable in the market, it gets what is called as the potential value. Till that time, it is only a product value or cost value. Whatever you have incurred up to non-marketing stage is called as value of the product just by total expenditure we have made. That's all. But the moment it gets the potential of use, its value gets based on projections, not based on expenditure. Till the stage it is not getting a market value or acceptance in the market, it is valued always in terms of the cost incurred up to that stage.
Okay.
Is that clear?
Yes, sir. Like in
Once
case initially, if the
your product is ready and ready to be released in the market, it goes by projections like we did today.
okay, so till that time, how it is done?
You
If
just go on adding the expenditure that you have
expenditure.
incurred
Okay.
and capitalize that. You capitalize
Okay.
that and show it as intangible asset in your balance sheet.
Okay. Okay. Yes, sir. Thanks very much, sir. Thanks very much.
So one question I have,
Yeah,
sir, a startup in a prototype stage,
yeah,
uh, actually where I am also into,
yeah,
uh, is in a position to secure a 5 lakhs grant.
yeah,
Also, he is has applied for a venture capital fund
yeah,
for a 30 lakhs grant.
yeah.
What should be the advice as we are still in the prototype stage? Should we go for the prototype grant of 5 lakhs or should we go for the venture capital fund where the venture capital has showed interest in the product?
Now, 1 minute. Here, the question is there are two simple questions, simple answers. First thing is grant. Is that grant enough for you to complete your prototype?
No,
Question is answered. Is that
no,
enough for you to complete your prototype?
no, sir.
No. Okay. Now, that means you can take the grant, but you still require funds.
Right.
Now, once you require funds, now how much fund you are getting from the venture capital and how is he valuing your product? Now that comes into picture. Now, if the venture capital is giving you 15 lakhs or 20 lakhs, what is the share he is asking you in the company?
26% with a plan for minimum 5 years agreed.
No, 25% is too high at this stage. It can only be 15, 10 to 15%.
Okay.
10 to 15% stake sale and 5 years exit is okay, but what rate? 5x or 2x or 3x?
That is not disclosed because they are also a government entity.
You can negotiate up to 5 years.
Okay.
And I don't know anything about the product, so
It's a
I'm
food
interested
process.
in advising you also.
It's a food product, sir. It's a food product.
All said and done, we need to understand the product well. Then we can. But this is the broad advice that would go to anybody.
Sure, sure. Thank you very much, sir.
Okay.
I think so. We can end the session right now.
Okay. No problem.
Thank you, sir. It was a very informative session, and I request all our participants that this is the basics what we are touching in financial management and valuation. We are going to have the advanced version of it. I think
Thank you, sir. Thank you.
in a couple of weeks. So be in touch with us, and there is more to come. Thank you.
Thank you, sir.
Yeah.
Thank
So
you, sir.
good day. Good day.
Bye.
Thank you
So any
for this.
Thank you.
So any kind of queries or any kind of information you required related to finance or valuations, you can directly contact us. I will be giving our email ID and phone number. So, so as an incubation center, we have all kind of services related to incubation, and we are presently undergoing our second cohort. So. Within a span of 3 to 4 months, we are going to have another cohort. So if you you have innovative ideas in the place, you can directly apply us. So be in touch in Facebook, Twitter, LinkedIn. So that is from my side. Thank you very much.
What about the PowerPoint, today's
Uh,
presentation?
I'm going to share you after within 2 hours to all
Thank
the
you.
email IDs what we are having right now.
Yeah,
So I'm
thank
going to
you.
send.
Thank you very much. Thanks, Satish Chandra sir. Very, very informative. Thank you, sir.
Sir, from NaaViC side, Satish Chandra sir, so we thank you for your valuable time and profound presentation. Thank you very much.
Okay, thank you.
Thank you very much, sir. Your patience is very much appreciated, sir. You handled every single question, whatever it may be. Your patience is really highly appreciable, sir.
Thank you. Thank you very much.
Thank
Bye.
you.
Hello.
Yeah.
Yes.
Hello, this is Rajeshri from Nourish Food Tech Private Limited. It was a very informative session, particularly to Satish Chandra sir. Thanks a lot, and thanks for organizing. We look forward to have more.
Okay. Thank you. Thank you very much, ma'am.
Thank you.
Thank you, ma'am.
Shrikant, see you here. I see there are so many like-minded people here. Is there any platform to come together or exchange ideas, work together? Any of the such
Definitely.
ideas?
Definitely, sir. Definitely. See, if you have any kind of ideas or any kind of things you want to discuss, then you can come directly to NaaViC. We can take it forward, or we can connect with you some like-minded peoples who want to create change in the industry or change in what fields they are into.
Sure, definitely. Thank you.
Thanks.
I'll be in touch with you, Shrikant.
Definitely. So I'm sharing my mobile number.
So I think we can end the session. I will stop broadcasting as well.